Hello everyone, this is Kourosh. So the company that I'm gonna present is Greif. It's a company in packaging industry. So this company was founded as 1877 in Cleveland, Ohio. They first started by making wooden barrels, casks, and kegs to transport post-Civil War goods nationally and internationally, and then they expand their business by actually purchasing 300,000 acres of timberlands to to provide raw materials for their own products and also to sell timbers. Currently, they have business units in 50 business units and manufacturing facilities in 50 countries all around the world. All around the world. So their main business consists of four segments: rigid industrial packaging, well, in which they produce steel, fiber, and plastic drums, intermediate bulk containers, closure systems, and transit protection products, and so on and so forth. And also they provide services such as blending, filing, logistic, warehousing, container lifecycle management, and their customers in this area includes chemicals, paint and pigments, food and beverage, petroleum, industrial coatings, agriculture, and pharmaceutical and minerals. They also do paper packaging. They produce container board, different corrugated sheets, and other corrugated and specialty products. They also do services in this area, and their customers include household appliances, small machinery, grocery products, building products, and some other customers. And the third segments of this company is flexible products and services. While they do flexible intermediate bulk containers, they also provide services in this area. They have similar customers. And finally, they do land management. They produce timberland, and specially used properties. They do services in this area, and their market, actually, their customers include active harvesting and regeneration of their United States timber properties. So, briefing the stock exchange. This company has two classes of share, Class A and Class B. Both are traded on the New York Stock Exchange stock market under the symbols GF and GF.B. So the latest stock price, which I got from Yahoo Finance, for Class A is $36.27, and for Class B is $47.62. And the latest market, or the most recent market cap, is for Class A is $1.74 billion, and for Class B is $2.28 billion. And the difference between two classes is in the voting rates. The Class B has the full voting rates, but the Class A has no voting rates until unless for a quarterly cumulative dividends upon the Class A common stock are in arrears. Accounting policies. So in terms of accounting policies, their policies are quite straightforward. They don't have strange accounting policies. They recognize revenue when the title passes and risks and rewards and transferred to customers or services are rendered. And foreign currency translation, I actually brought up this point because it is very important for this company. So as I said, they have 50 business units, they have 50 operational business units in other countries. So foreign currency translation affects these companies severely. As a result, for example, of a 14.7% decrease in sales of 2015 compared to 2014, 8.7% was due to these foreign currency exchange, the negative impact of foreign currency actually translation. And the transformation plan, this is a very important part of this company. So the transformation plan, actually, it's a 3-year plan designed to significantly improve the performance of the company by optimizing their portfolio, reducing costs, increasing gross margin, and aligning resources for future growth with their customers. So as part of these plan, they also make investment in several plans to meet their short-term and long-term customer needs. They also write off their some of the equipments and plants that are not operational and useful in producing goods or services. So this is a very important point about this company. So the ratio analysis. So in the first table, I kind of compare the um, important ratios of these companies with three other companies which are in the same range of market cap as Greif, and also I compare it with the average industry. So that the P ratio for Greif is 24.12, which is pretty close to 23.4 average industry, but higher than the other companies, the other three companies. And the ROE is 7%, which is pretty low compared to 18.6% of average industry, and well, the 21 point roughly 8% of graphic packaging holding company. The debt to equity is 117, which is lower than 123 and also lower than New Island Printing and Graphic Packaging Holding Company. Well, based on these results, we can say that the Greif is not a risky company, since yeah, the debt is almost equal to equity and is lower than the average of industry and other companies. So it's not a risky company. And the price, the last column, shows the price to book ratio, which is 1.692 for Greif, and is lower than the actually other three companies. Well, which actually this tells us that this tells us that investors have less faith in this company compared to the other companies, probably. And down there at the second table, I kind of break down the ROE using the basic DuPont's model. So we can see the actual ROE for 2012 to 2015, and then the forecast ROE for 2016 that I come up with. So we can see that the majority, the net profit margin is pretty small in the actual years and the forecast year as well. And the ROE is mainly driven by the total leverage, and net profit margin, as I said, it's pretty low. Net profit margin can be actually interpreted as a direct measure of the performance of the company, which here it's saying that the company is not really doing well. So going into the forecasting, first, before I jump into the forecasting sales, I just brought up these charts so we can see the trend, the sales trend for the past 5 years. From 2011 to 2014, the sales trend is kind of stable and constant, except for the slight changes from 2011 to 2012. But if we just ignore that slight change, we can say that the sales is pretty stable from 2011 to 2014, but it suddenly drops dramatically from 2014 to 2015, from 4,200 million to 3,600 million, which is almost 10%. So this is basically telling us that the past trend, the historical trend, is not a good actually way to predict the or to forecast the sales for 2016. So here the sales is kind of broken down by the different segments. So as we can see, the rigid industrial packaging and service account for the majority of sales, almost 75% for year 2011-12 to 2015. So basically we don't need to consider each segment separately, so I can use the total net sales because the majority of sales come from the rigid industry packaging. So down there also the operating profit is reported for 2011 to 2015 based on the 4 different segments. And the interesting part of this is that, as we can see, although the net sales remain constant from 2011 to 2014, we see these decreasing trend in operating profit from 2011 and 2014. This is mainly because of the foreign currency translation loss, and also another reason is reducing price in this years. So they have to keep their current customers. They had to keep the customers, so they had to reduce the price because the market is really competitive in this industry. So again, this is the sales by segment. This is a histogram, which is pretty clear. As I said, the rigid industrial packaging and service accounts for the majority of the sales. And then the paper and packaging, and then flexible products and service. So as I said, the historical trend is not a good way, or is not a good measure to actually forecast sales for the next year. So since the company released its earnings per share for the first quarter of 2016, I just brought up the numbers from the report and compared it with the first quarter of 2015. And as we can see, the sales has dropped sale is dropped by 14.5% from the first quarter of 2016 to first quarter of 2016 compared to the first quarter of 2015. The sales has dropped by 14.5%. So, but the table below, so I'm reporting the quarters, the first, second, and third quarters of 2015, 14, and 13, recording the sales for each segment, the total sales for each quarter, and the total sale for each year. And the last row actually gives us the ratio of the sales of each quarter by the total sale of the year. And as we can see, the ratio is kind of 25%, 26%, 24, 25, 27. So basically what it's saying is that there is no seasonality in the share and the sales of these company, and each quarter kind of represents 25% of the share of the sales of the whole year. So with this reasoning, I am gonna use the first quarter of 2016 and just consider that as 25% of the whole sales of the whole year. So here's the forecasting assumptions based on the historical information of first quarter results. So as I said, I'm going to use the first quarter of 2016 as 25% of the sales of the year 2016. And then I assume 3% decrease in SG&A due to transformation plan. So as I said, they initiated this transformation plan in May 2015. And SG&A expense in 2015 due to this plan actually has decreased 3% compared to 2014. So I am just assuming that in 2016 compared to 2015, the SG&A will decrease by the same rate, which is 3%. And 1% decrease in depreciation expense due to transformation plan. Well, as I said, as part of these transformation plan, they write off the equipment and the plant that are not operational anymore, that are not useful. So they write them off, and also they shut down those business units within the United States or outside of the United States that are not they're not generating profit for the company. So this will, I believe, will result in a decrease in depreciation expense, but it will not be material, and that's why I'm assuming that the company will experience 1% decrease in depreciation expense in the next year. And the common shares outstanding is 47,800,000, which is the sum of Class B and Class A shares in based on the numbers in the first quarter of 2016. And the cost of equity capital that I use here is 9%. So I use CAPM to calculate cost of equity capital. I come up with different cost of equity capitals using different methods, different betas, different risk premiums, and different actually risk-free rates. And then I use the average because these numbers are from 7% to 11%. So I believe that 9% is reasonable for this company. And based on these assumptions, so the estimated price per share based on these stated assumptions is $25.56, which is pretty low compared to the current market price, which is $36.27. But I think that with the current situation, and especially with the current result of the first quarter of 2016, this price is pretty optimistic, and I think market is overpriced this stock. So the sensitivity analysis. So as I said, I used the CAPM to come up with cost of equity capital. I used different risk premiums, different beta. I used the firm specific beta, industry average beta, and then 10 years treasury bond and long-term treasury bond. And I calculated different cost of capitals. And as we can see that I have cost of equity capital from almost 7% to 11%, and the associated prices with each rate are given. Prices are given here. So the prices range from $23.3 to $29.6. So I use the 9%, which is kind of the average of these rates, and I think it's pretty reasonable for Greif. Thank you very much.